Are you tired of feeling like your finance know-how is a few steps behind your job's demand? Well, I'm here to fix that. Join me as I walk through the top 10 financial modeling skills that you can't succeed without. No fluff, just the facts. Here's the thing. There's almost nothing more important to a finance and especially a financial planning and analysis or FP&A role than financial modeling. But the thing is, nobody sits down and explains financial modeling to you. Sure, they'll teach you different piece parts as you do your job, but no one teaches you what's important to really develop your financial modeling skills across the whole process. So that is exactly what I'm going to do today. I'm going to show you the full stack of skills to kick your modeling skills up a notch and impress your boss. Make sure to stick around to the end for the number one biggest thing I've learned in my career about financial modeling. While you're watching, scroll down to the description and click that link to join my free newsletter. I'll send you a free guide to 25 ways to use AI in accounting and finance, and financial modeling is several of those ways. So with that, let's kick off number one on our list of the top 10 financial modeling skills. Number one, understanding accounting. You cannot look forward if you don't understand the past. Here's the critical things you need to know about accounting to effectively model. First, the three financial statements. That's the income statement, the balance sheet, and the statement of cash flows. You must understand these three statements and, more importantly, how they all interact together to truly effectively model. Second, you need to understand how your company recognizes revenue. This can be different across industries, and it's important to understand in detail the difference between when a customer has work completed and when you'll actually record the revenue. You can't forecast if you don't understand the actuals. And lastly, how does your company recognize expenses? Sure, there's the matching principle, expense matches revenue, but again, this is very industry dependent. Let's move on to number two, business drivers. What makes your business tick? The first and most important thing is that you understand the industry. Your business does not operate in a silo. It operates in an industry, it operates in a broader economy, and you need to understand what is different about your industry, what's happening in your industry, and how it could impact your business. Similarly, you need to understand everything about the business you support. If you could do just one thing to improve your financial modeling, it would be truly understanding the business. Build relationships with operations. Find out who else in the business has data. This could be the sales team, marketing, consumer insights. This becomes incredibly important as we think about the real drivers of rate, volume, and mix. Let me give you an example of what rate, volume, and mix means. Let's say that you're running a restaurant, right? In this restaurant, you have customers. Those customers are your volume. You have rate, how much you charge for individual products. And then you have mix. Those are the different types of items customers are buying. The more expensive ones, the less expensive ones. So as we think about business drivers from a rate, volume, and mix standpoint, in this restaurant example, let's say that you've recently increased your prices by 10%. That is a rate increase of 10%. However, from the higher prices, you get 5% less customers. That's a decrease of 5%. But as part of the pricing increase, you actually saw customers buy more high-end expensive items like steaks, and you saw them buy less expensive items like dinner salads and the pasta. That means that your mix improved significantly. By understanding that, instead of just saying my revenue's up or my revenue's down, you can deconstruct what's happening in your business and provide a lot more robust explanations, and you can also build better models going forward. Number three, your forecasting toolbox. Now, in some ways, this is something that develops over time as you learn more and more, but I wanted to call out some of the most important things that you should have in your toolbox. The first, we talked about on the last page, driver-based forecasting and understanding how rate, volume, and mix can impact your business. This really goes by your industry. You need to understand, like we said on the last page, what drives your business, what drives your industry, and pull those into your forecasting. Rate, volume, and mix become your drivers, right? Then there's time series analysis. This only works if you have a lot of historical data if your business has been running. Time series analysis uses your historical data to project the future using statistical models. And there's a lot of software that will do this for you. Then there's econometric models. Not everything in finance is easy to say. There's econometric models that allow you to look at trends or macro drivers happening in the economy, try to correlate them to your business, and then project that forward based on how your business has performed in the past. And lastly, there's qualitative factors. This goes back to business knowledge. It's things like talking to your sales team to understand what customers we may be gaining or losing. This could be talking to, if you run a restaurant, your chefs and understand what they're seeing happening the out in the food supply business. All kinds of things that aren't directly quantitative but can be a big impact on your forecast. Let's move on to number 4. Mastery of Excel. Now, some would say that this is number 1. I think that it's better to understand the business first, but after that, as we get into the true technical skills, Excel is absolutely critical. The first and most important thing is not a formula or a function. It's being organized. Your forecasting models need to have a clear flow to them. The way that I like to organize my models, I will have a tab with all of the data. Could have several tabs for data, but you have your data separate. Then you have a tab for inputs and assumptions. And then from there, you build your model, right? You don't want to have your data directly in the model. You don't want to have your inputs and assumptions there. This lets you know step by step where things came from. The data that came from your source system, the inputs and assumptions you're making, and the forecasting model. It also allows you, if you change an input or assumption, it will flow through the entire model. The most important thing you can do is stay organized. Then, of course, there's some key functions you need to know. Sum ifs. I've rarely seen a good forecasting model that's not using sum ifs to pull from the data set. Index match is a great way to pull in a lot of those key assumptions from your assumptions page. And offset is a great way if you're trying to forecast using time series or looking backwards. Offset will let you move through your data set and pull things in from historical periods. There's a lot more you could know. This is an ongoing skill set you'll be learning forever. There's so much more in Excel for financial modeling than I could ever cover here. To learn Excel in depth, I highly recommend you check out the Accelerator course from Miss Excel. I have an affiliate link down in the description, which will give you a significant discount off the rack rate on all of her excellent courses. This is truly the best way that I've seen and what I use with my own teams to improve their Excel experience. Now let's talk about number 5, scenario analysis. There's a 5-step process to follow for scenario analysis, and what this does is it lets you build multiple scenarios instead of trying to say you know exactly what's going to happen. Step 1, you want to identify the uncertainties. What don't you know? Where are your weakest assumptions? And how could that impact you? This could be things like consumer demand, macroeconomic trends. If you're in financing, this could be interest rates. What are the uncertainties? 2, develop scenarios for those, right? So what is I always do worst case, mid case, and best case scenario. Analyze each of those scenarios. Run a model for each of those scenarios, assuming what the impact would be across your business. Then, once you have those, develop strategies to get from the worst case up to the best case. How are you going to mitigate the downside, and how are you going to improve the upside? And lastly, monitor and adjust. Once you have these scenarios, you need to understand which of the scenarios you're tracking to and adjust your strategies and forecasting as you move forward. Number 6, data visualization. This is where I say that a wall of numbers never helped anyone. It's impossible for your clients to digest, and even for those of us in finance, your eyes just glaze over by all the information you're receiving. This is where it's critical to go beyond the model and start helping people understand what is being told in the model. There's a few really common ways you can do this. The first, and my favorite, is a cause of change, right? Because we're planning, that implies that we have kind of a base period or a prior forecast that we want to compare our new expectations to. Causes of change allow you to break down why things are changing. Business drivers, back to what we talked about earlier. And there's a few ways you can do this. You can do this in a chart where you walk from your prior version down to the current one. You can do this in a waterfall. This is really good for your business partners to understand. You kind of start on the left, say, here's the base, we're going to move over here, and then you break down from cool little chunks of red and green saying up or down, how are we doing? And you can tell very good stories that way. There's also a lot of ways to look at trends. So as you think about trends, you can do line charts, you can do bar charts showing a change over time. I like to do something where I look at shares of a business as a percent of 100. It's kind of like a pie chart, except it's a stacked bar chart, and it shows you multiple years, and you can kind of see how the business changes over time. It's kind of a cool way to integrate the pie chart concept with trends. And lastly, you can do comparisons, right? You can do side-by-side bar charts to say this is what it was before, this is what it is now. A cause of change in itself is kind of a comparison. There's a lot of different ways to do this, side-by-side pie charts showing how things have changed to help people really understand what's moving in the business, what's changing, and why it's changing. Number 7, attention to detail. Accuracy is absolute table stakes in everything we do. In finance and accounting, we cannot be wrong when it comes to the numbers. We can be off when it comes to assumptions or drivers or strategy, but we cannot be off when it comes to the math and our models working. So how do you make sure you do this? First, build checks everywhere in your model, right? Make sure that totals equal the sum of the parts. Make sure that the data set you're bringing in is accurate. When you look at your prior period, check that against forecasts you've done before, check that against reports that have already gone out, and make sure all of the numbers are the same. Tick and tie everything and build these checks in automatically, so all you have to do is scroll down. I personally like to highlight my checks in red so I can just quickly scroll down a file, see if everything ties out, and then if I need to send it to somebody, I can just collapse all those, hide them, and it's all set. Another really important thing, aside from you checking your work 2, 3, 4 times, depending on the audience and how important the work is, peer reviews. If you're talking about something going to senior executives, senior leadership, especially external, peer reviews are your best friend. Get additional eyes on it, get your team on it, help them with their work, make sure that everything that goes out is accurate, because it not only reflects on you, it reflects on the team and the entire organization. Now we'll move on to number 8, effective communication. I could have put an entire list of bullet points on this slide saying storytelling, because the most important thing about a financial model is telling the story of your business. It's not about the numbers. This is a real business that is operating in the real world with all kinds of shades of gray between black and white. You have to tell clear stories. If there's not a story, it's just a bunch of numbers on a page. And when you communicate, it's equally important to be very confident, right? People will listen to people who are confident. How do you build that confidence? First of all, trust your model with all of the steps we've talked about here. And second, bring a lot of backup. I mentioned on the last slide that a wall of numbers never helped anyone. Well, that's true in a presentation, but I always walk in with my walls of numbers, my models open, ready to answer questions. Because if you're able to answer the majority of questions that come your way, then people will automatically see a higher degree of confidence and higher trust. You don't have to be able to answer every single question. That's totally fine. Some things will kind of go beyond the scope of what you've done. I always shoot to be able to answer 80% of the questions that come my way and leave the other 20% for follow-ups. Moving on to number 9, you need to have a problem-solving mindset. Keep in mind that you will never have all the information you need when doing a forecast. I've never had all of it. You won't have all of it. This means that we have to make assumptions throughout the process. The key thing is that you test your assumptions. Run your assumptions by your peers, by your leadership. See if they make sense. See if they hold water. Look back across history. Make assumptions without looking at historical data and see if those assumptions were relevant in the past. And then most importantly, come back and test your forecasts. See how accurate they were as actuals come in. It's critical to adopt a problem-solving mindset, acknowledging that it will never be a perfect world, but finding ways to deliver a lot of value. And lastly, this is the most important thing that I've learned across my career: continuous improvement. No matter how much time you spend on it, no matter how good your modeling skills get, every model you ever build will be wrong. Every model I've ever built has been wrong. What's important is that you know why you're wrong. You know why you're wrong. You know what business drivers you missed. You know what changed in the business, and you can explain it. And then you improve for next time where you can. This is important because you're never going to be able to guess everything that's going to happen. Think about the insurance industry. How do you know when there's going to be a hurricane that hits the southeast or a major snowstorm that shuts everything down? You don't. But you need to understand and be able to speak to the fact that you expected X number of claims, Y number of claims occurred, and this higher number of claims occurred during a snowstorm. You can also look and say, oh, we didn't put in a contingency for any snowstorms to happen in the winter. Next time I do my forecast, I'm going to build in a contingency because there's a high likelihood that will occur. Finance and financial modeling is all about doing better the next time and being able to tell a clear story about why you missed. If I could leave you with just one thing from this entire video, it would be to be continuously improving, always striving to do better, because in striving to do better, you'll be continuously developing yourself and developing your financial modeling skills. So there you have it. These are the top 10 financial modeling skills that you can't succeed without. Practice these skills and you'll not only survive the finance world, you will thrive in it, you'll impress your boss, and you'll have a great career. Thanks for tuning into F9 Finance. Of course, don't forget to like, share, and subscribe for more unfiltered finance content coming to you weekly. I'll see you next time.